Hello everyone, and welcome to another exciting year of economics and financial markets. A lot ahead of us. Stay strong and remember to have fun also. Okay, on Friday we saw the US stock market leap higher on that jobs data, but we all know jobs data is the most backward-looking economic indicator there is. Plus, at 223,000, the December jobs number was still well above pre-COVID levels and 23,000 higher than what market expectations were. So I think there was a lot of market positioning in place that really this was just a catalyst for the unwinding of. So the market had a very good rally. In fact, the US stock market was making new lows out of a 4-week range, and then it closed at new highs out of that 4-week range. Very interesting price action indeed. And one would have to say that price action closing as it did is bullish US equities. However, we saw price action like this at the start of 2022, where the US stock market actually was making new all-time fresh record highs in the first week of 2022. And I wrote and said then and there that these could well be the highs for the year, and I still saw potential for a 20% decline in the US stock market. The US stock market fell 19% last year, so that was a pretty accurate forecast. Now, I'm not as confident this year as I was last year of the downside story, but I am still most definitely leaning in that direction. So I see risk this year of the second week of trading, the week we're in now, seeing the highs possibly for the year and a 10 to 20% decline, whereas last year I was really looking for a 20 to 30% decline. This year I'm looking for a 10 to 20% decline from current levels. But do keep in mind, I'm trying to emphasize the directional risk. The move could be even greater than that if I am correct, but all of that remains to be seen. All I would suggest to you that on Friday, we also saw the ISM for Services PMI data for the United States, and that fell into contraction. Yes, contraction. The services sector, which employs and is the largest part of the US economy, was in contraction in December. Adding to what we've been seeing recently in manufacturing and industrial output, this would suggest the United States was already headed into recession in December. So it's not really painting a very rosy picture for first quarter GDP for the US at all. Now, one of the reasons, and perhaps the main reason the stock market's rallying, is that it sees bad economic data as cause for celebration because it would somehow lead to a better outcome from the Federal Reserve. Now, that's not the case at all. As Chairman Powell and many board members have said repeatedly that they want economic slowing, they want the employment market to cool far more than it has, to bring inflation down in a sustainable way. What they're concerned about is that any momentary decline in inflation, if it isn't matched by a much more sort of crumbling, deep feeling of slowing of US economic growth and the jobs outlook, could be short-lived. So they do not want to ease off the interest rate hikes only for inflation to take hold again. So they will be hiking by 50 points for another 2-3 meetings. And if there's any uptick in inflation, it could be another 4 or 5 meetings. So the Fed terminal rate, as it's called, will still be much higher than the market is pricing. And I still believe that that is cause for caution on your investment portfolio in general. There is an argument to be made here that perhaps people should just be getting long given the Friday's price action. It is a new year. Let's all be positive. But as I try to point out again and again, being positive is not the same as being bullish, or being bullish is not the same as being positive. You've got to be positive about bull and bear markets because markets do have both of those trends in them. So it's a little bit like people who complain about the rain. I mean, you know, it's nice when it's sunny, but I also like it when it's raining. Why? That allows me to make the most of every day. So you need to be able to buy in bull markets, you need to be able to sell in bear markets so you can make the most of every day and every trend in markets. How's that for a little bit of philosophy there? Overall, though, economic data in the US continues to point south, savagely south. Do not underestimate how bad the downturn for the US economy is looking. Do not underestimate how resilient in its rate hikes the Federal Reserve will continue to be, which of course contributes to that economic downside in the US economy. So that said, today, Monday trading, we should see some further upside momentum in equities as people follow on from those strong closes in New York. However, in New York trading tonight, there should be some follow through as well. But I see Tuesday, Wednesday New York trading as being a potential top. If I'm proven wrong, we could be in for a bull market this year. But I would be watching Tuesday, Wednesday, Thursday, the latest probably, for some kind of top in the US stock market. And if we do see that, and you see the market falling back into that recent range of recent weeks, do be careful about your overall investment portfolio for the outlook for 23. All the best, Clifford Bennett, Chief Economist, ACY Securities.